there's so much noise around Bitcoin and there's so much negativity around it in the media that by and large, we're in our little bubble over here. But by and large, the vast majority of people do not understand it. They don't trust it. And they think that it's for criminals and for money launderers and for, people traffickers. They do not get it. And so funny enough, I thought, and I've been saying it for years, that you can get in before Wall Street takes over, but Wall Street is taking over.
One of the most striking observations Lavish makes is that despite Bitcoin's growth, most people still don't understand it. Outside of crypto-native circles, Bitcoin is still widely perceived as a tool for criminals, a speculative bubble, or a risky, unstable asset. This perception gap is critical because while retail investors hesitate, doubt, and often mistime their entries, institutions are doing the exact opposite. They're accumulating. Lavish highlights a surprising reality. Wall Street has quietly positioned itself ahead of the public. Major players are no longer ignoring Bitcoin. They are actively integrating it into their financial systems. MicroStrategy has accumulated hundreds of thousands of Bitcoin as a treasury asset. BlackRock has launched a Bitcoin ETF. Fidelity Investments is offering Bitcoin exposure to clients. Even traditional giants like JP Chase and Morgan Stanley are now involved. This is a profound shift. Years ago, the narrative was, get in before institutions arrive. Today, the reality is, institutions are already here, and many retail investors still haven't arrived.
Interesting thing, LG, is that, years ago, I thought, well, once institutions get into this, that's it. It's going to be you're going to be left behind, and it's off to the races. The funny thing is, and this comes to what I think is the biggest risk to Bitcoin, which is just the delays of people understanding it and embracing it. And here's the funny thing is that somehow, once again, Wall Street has figured out a way to get in there before retail. And there's so much noise around Bitcoin and there's so much negativity around it in the media that by and large, we're in our little bubble over here. But by and large, the vast majority of people do not understand it. They don't trust it. And they think that it's for criminals and for money launderers and for, people traffickers. They do not get it. And so funny enough, I thought, and I've been saying it for years, that you can get in before Wall Street takes over, but Wall Street is taking over. You're seeing, MicroStrategy buying 1 million Bitcoin here. He's got just under 800,000 Bitcoin now. And you're seeing BlackRock come out with their Bitcoin ETF. You got Fidelity is involved in it. They've got their ETF, and then a lot of the other ETF managers. And now you've got places like JP Morgan Stanley. Vanguard is even offering it to their investors now. And so you're seeing institutions get involved, and you're seeing larger institutions starting to put it on their balance sheets and putting it in their funds and in their portfolios, while by and large retail still fumbles around with it, and they're buying and selling really poorly. They're buying it on hyped moments, and they're selling it on panic moments. I have personally painfully witnessed this with people who I've been telling about Bitcoin for a while, and they finally get in up towards the all-time highs. And then when it breaks 100, it goes down. They're like, I don't understand it. And they get out, and they lose 30, 40, 50% of their investment because they just, they don't understand it. And that's the word. It's not that they're not smart. It's typical. So what holds Bitcoin down is this continued misunderstanding of it for the general population. And so institutions they'll continue to put their positions in place. They'll continue to put their products in place to get ready for that influx of your everyday person. And so, and when we get through this current period of uncertainty, LG, and this does march back towards 100,000, you're going to see people they're going to get that hot ball of money that we saw going toward gold and silver is going to come into the Bitcoin space again. And that hot ball of money is something that I've written about, which is just that the people who are lagging, the bottom leg of that K-shaped economy that I talked about earlier, are trying to catch up. And so they're chasing trends, they're chasing what they think is hot. And it used to be the meme stocks, and then it was Bored Apes, and then a lot of cryptos, and then it became gold and silver, and God knows what it's going to be next. But there's a hot, it's poly market, it's Kalshi, it's the betting on the Masters on the 16th hole with 2 holes left. They're putting down thousands of dollars to try to really quickly make up some money. And so it's kind of crazy, but that's the world we live in now. And so patience and understanding are going to be key for people who are getting into this space. I cannot emphasize that more.
Now we arrive at the core of Lavish's thesis. Liquidity drives everything. To understand Bitcoin's long-term trajectory, you must understand the macro environment, especially government debt and monetary policy. Let's break it down simply. The United States currently holds tens of trillions in debt, with total obligations, including unfunded liabilities, approaching staggering levels. And here's the key insight. This debt will never be fully repaid. Instead, it must be managed. Lavish outlines what he calls the 4 doors available to governments facing massive debt. 1. Austerity, cut spending. Politically unpopular and economically painful, unlikely to happen at scale. Raise taxes. This runs into limits described by the Laffer curve, where higher taxes eventually reduce productivity and revenue. 3. Default on debt. Catastrophic for trust in the currency, essentially not an option for major economies. 4. Print money, the default choice. This is the path governments consistently choose. By expanding the money supply through mechanisms like quantitative easing, QE, central banks inject liquidity into the system.
You asked about liquidity. Why does it all matter? Why does that matter so much? Well, I use the U.S. because they're the largest source of liquidity outside of China. But I use the U.S. with the U.S. stock market being so integral to everything that is going on down here. And the situation we're in. It's pretty simple math. We currently we have $39 trillion of debt plus hundreds of millions of dollars of unfunded liabilities. Let's call it just under $200 trillion. But we have so much debt on our books that we are now running multi-trillion-dollar deficits every single year. So our debt doubles every 10 years. It doubled from 10 years ago to today. It's doubling again in another 10 years. So we're going to be bumping up to $100 trillion of debt in the mid 2030s, and which is just mind blowing. Their numbers are just too big for everyday people to make sense of. But why that matters is that we're never going to pay this debt down. When you hear the Treasury Secretary speak, he admits this. It's like, this is not something that's just going to be paid off, but it's got to be managed. And the way they manage that is by making sure that there's enough liquidity in the system to continue to fund the deficits that we are running. And for the listeners, I've talked about this extensively, but it's basically you're running these deficits that they can't be wiped out. You have what's basically what I call the 4-door problem, which is that you have 4 doors you can go through when you have so much debt, you have so much debt to GDP, and you've got these deficits. And the 4 doors are, you've got one option, which is to have austerity, which is to cut spending. You saw the Doge Commission. They tried to cut spending. They tried to get out all the fat and all of the the fraud, but it's just overwhelming. And the amount of need outside of all that is too great. So each side tries to trick each other into cutting spending on their constituents, but they're not going to do it. They're not going to cut Social Security or Medicare or Medicaid, which are the biggest pieces of all this. They're not going to cut defense spending. Obviously, we've just entered yet another war, and they're not going to default on the debt, which is to say that they won't pay the interest on it, which is it's $1 trillion. That's basically half of what the deficit is. So they're not going to default on that. So they're not going to cut spending. I mean, the second door is you could raise taxes. And if you raise taxes, if anybody has never ever seen the Laffer curve, it's basically this curve that says that as you raise taxes on productivity, you get to kind of this spot where it levels out because productivity is hampered by taxes. Why is that? Because the company stops investing in profitable business lines, stops hiring people, stops doing R&D, research and development on new lines of business. So you get to the curve, just kind of tops out, and that's it. That's the top of the amount of taxes you can get. And the problem is, then now you've got a declining curve of productivity, and so that ultimate tax point only lasts for a little bit of time, and then it starts going down. So it doesn't work. We've seen it in Europe. It doesn't work. The productivity is hampered, and it's just not a good direction to take the economy. So what's your third door? Your third door is you can just default on the debt. Just default on the debt and just write it down, which you've seen emerging markets do, and they've been hammered by that. But once you do that, then you can no longer use debt in your own currency. Your currency is hammered by that, and people don't trust it anymore. So it's not something we would ever do. Why would we never do it? Because we issue debt in our own currency. And so that brings us to the fourth door, which is the easiest door to walk through. It's the one that we walk through every single day, which is print more money and use that printed money to service that debt, basically. And that's called fiscal dominance. And so you just continue to create more money in ways that expand the money supply through, there's a lot of different ways you can do it, but basically you can either do it through banks and lending and through the Fed creating larger balance sheets, or you can do it by just literally printing money and buying your own debt, which is what we're getting to. And that is called QE, quantitative easing. And so people hear this all the time, QE, QE, QE. Well, you have two ways that the Fed can move. They can either have QE, which is printing money, buying assets, typically US Treasuries and mortgage-backed securities, or they can do QT, which they start drawing liquidity out of the market. Well, they did QT for a little while, barely. They were doing $60 billion a month. They pulled it down to 30 billion, then 25 billion. Now they just cut it off completely. Now they're back in the market, and they're doing what we like to call QE light, which is they're buying T-bills. Basically, they've been adding liquidity to bank reserves in order to keep the system going. So everything you heard me just say, all it means is we need liquidity to manage all of that debt. There's no way around it. The math is you need more liquidity to manage that debt. And by that, I mean, you have to create more dollars. And what happens when you create more dollars? Think of it as a monopoly board. If you're all sitting there playing, and then suddenly your buddy gets a whole bunch of money from the bank that they just give to him, lend it to him, then suddenly there's more money on the board. And so what happens to all the assets on the board? They go up in price. And that's what you're watching every single day. Assets go up, houses go up, land goes up, gold goes up, stocks go up, Bitcoin goes up. Over time, that's what happens. They do this along the way, but over time, that's what happens. And so that gives you great comfort if you're an investor and you're sitting here in these assets. If you're sitting here in Bitcoin, and some of the other ones that do have utility. I'm not the kind of person that says that everything is a garbage unless it's Bitcoin. There are some things that will have utility. There's no doubt about it. I'm just focused on Bitcoin. But if you sit here and you have that, and you've been stomaching this volatility, it's okay. I mean, we're just going through uncertain periods, and that's normal. And it's actually normal for an asset that's being adopted. Remember, this thing is only 16 years old, 17, going on 17 here. It's still a teenager. If you think about it, gold now has $30 trillion of market value, basically total market value. I mean, Bitcoin's over $1 trillion. I mean, gold's been around as money and as a store of value for thousands of years. For Bitcoin to be 1/20th or 1/30th its size, that's astounding. It's absolutely astounding. So be patient. The liquidity train is coming, and right now we're getting a trickle to a stream of liquidity in the US. But if we have some sort of event that is a 100-year event, God forbid, but we know it's coming.
Lavish's message ultimately comes down to one word: patience. Bitcoin adoption is not a straight line. It's a volatile, uneven process driven by education, market psychology, macroeconomic forces, but the direction, in his view, remains clear. We are witnessing the early stages of a global monetary transition. And while short-term uncertainty is inevitable, long-term trends are shaped by increasing institutional adoption, expanding global liquidity, and growing recognition of Bitcoin's role as a store of value.